In this week's video, we'll cover a rare stock market signal that's only been seen 3 times in the past 35 years. We'll kick off the video with Friday charts and then shift gears to Thursday evening when we covered some recent studies and signals, and then link back to Friday. You can pause your video player here, but we really haven't seen anything that tells us anything's changed significantly on the Fed and or inflation front. Everything that we just said about the last slide applies to this slide. I believe we've covered this concept in the past. Present day, you can make an argument really doesn't have a breadth thrust look to it. In fact, looks eerily similar to this box here. The Nasdaq peaked in November of last year. The S&P 500 peaked early in 2022, and yet a lot of these breadth indicators aren't in major oversold territory. You can compare the present day here to other major lows in the rear view mirror. It tells us it's possible that further damage needs to be done before we reach oversold levels. Same concepts here. S&P 500% of stocks greater than their 200-day moving average. Here's a low here in 2010. One of the higher levels relative to where lows occurred, quite a bit higher in the present day. As of Thursday's close, you could make an argument that this is a bullish divergence, but given the weight of the evidence, the fact that we're still up here relative to these lows is probably more relevant. Same exact concepts here. Lows since 2009 occurred where these green horizontal lines are. Here, this is S&P 500 stocks greater than their 20-day, 50-day, 150, and 200. Same concepts here using the Nasdaq 100. Still have quite a bit of white space in here relative to these lines. White space here relative to these lines. The Nasdaq Composite looks a little bit better, but given the fact that it's been falling for several months, this tells us more damage may be in the cards. Pause your video player here. NYSE percent of stocks making new highs minus the percent making new lows goes all the way back to 1972 on the left side of your screen. Exact same concepts. 1987 crash. This is where we are when we find a bottom. You can see in the present day we really don't look like any of these major bottoms down here, possibly with the exception of this period in here where markets continued to fall for quite some time, or the 1994 period would give the bulls something to hang their hat on. Indicator on the lower portion of your screen, NYSE up volume divided by down volume. You can see near major lows, sometimes we get a spike. 2019, we get a spike. Doesn't really look like we have anything like that yet. This is the S&P 500 on the top as of April 29th. I've covered this before. Was concerning last week, still concerning. So Nasdaq relative to average and median drawdowns since the great financial crisis. You can see here, this is Thursday's close right here. Still somewhat in the range here. Friday's close starting to move away from this territory. Also speaks to increasing bearish probabilities. Basket of physical commodities relative to the S&P 500 as of April 29th. It's a monthly chart going back to 2002. Aligns with these concepts that we covered in the April 15th video. Have to keep in mind here, this is a positive figure up here of 14.51%. But you can get outperformance when commodities and stocks are weak, hypothetically. Commodities could just lose less. And that concept applies to all of the commodity studies and charts that we've covered in recent weeks, including Dean's study from Sentiment Trader. Dean performed a study this week looking at the US dollar, some movements in the dollar, rare movements, and subsequent performance in stocks and commodities. It tells us to take a measured approach with both asset classes walking forward. This is that monthly momentum rolling over. We performed a study. This is the MSCI World Index ex USA. Bearish monthly cross here. Only happened a handful of times going back to the year 2000. We're using all of the data that we have. The average drawdown, 16.95%. That would be an additional drawdown in the present day. Median, 11.04%. Hypothetically, the median and average would land in this area, hypothetically, for the S&P 500 in the present day. If we take this data and put it on a 2022 chart of the S&P 500, it really tells us that if we can't hold these areas in here, then more downside may be in the cards. We have seen some damage in the past 2 to 3 weeks, but the Dow is firmly in this trading range, the same one that we covered last week. NYSE Composite, as of the close on Friday, April 29th, still retesting this low. We don't make any assumptions about whether the retest is going to pass or fail. Trade the chart in front of us. There's no question that bearish odds have increased relative to being up here just a few sessions ago above the 200-day moving average relative to being down at the bottom of the range. But we're still in the range as of Friday's close. How about the secular trend thesis? This is somewhat of your bull-bear demarcation line, the 200-week moving average. You can see the COVID plunge here. 1987 would be another example. You can get large drawdowns within the context of a secular bull market, so it really doesn't change anything on that front, and that's not really relevant in the short to intermediate term. Here's an index that's left the range, S&P 600 Small Cap Index. Here's high-low close bars, same chart as of Friday's close. You can see during the session on Friday we were above this level and above this level, and then we closed below both. There's a reason why we have the term failed breakdown. The longer a bearish breakdown remains in place, the more relevant it becomes. Here's a chart we covered last week, and we highlighted this area in here of congestion. You can see the chart, 11:45 a.m., Friday, April 29th. If we fast forward to the close, the weekly chart's still hanging out in this general area. No question this is a retest look as well. S&P 500 close April 29th. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. Also has a retest look still. We closed above this low here at 41.14 and change. To close on Friday was 41.31 and change. Same basic concepts, just some other reference points. Some of them have been exceeded, others are still in play. We're still within that typical drawdown range that we discussed way back in January. That doesn't mean we're going to stay in that range. Like everything else, it helps us assess probabilities. If we get down in here, it speaks to increasing bearish probabilities. Equal weight S&P 500 index close April 29th, still in the range for now. This is XLK relative to XLE. Here's a gap up here. This is early 2020 when COVID fear peaks. We've come all the way back to that gap now, testing the same gap. Amazon divided by the S&P 500 doing the exact same thing. Like everything else, not making any assumption whether this is going to bounce here or move in this direction. Take it day by day, trading the chart in front of us. QQQ relative to SPY is out of this box here, at least for now. Same can be said for SCHG relative to SPY. 10-year yield roughly around noontime on April 29th. Nothing here says anything has calmed down yet. You may remember in the April 15th video, we said stocks may be more vulnerable than they appear. And in Q4 of last year, let's say in this area here, we noted numerous times that the S&P 500's trend was still extremely strong. And that was true at the time, and that ended up being relevant. Here, you're really not far from an all-time high. And here, you're really not far from an all-time high. And in this general area here, the drawdowns in the S&P 500 index and the drawdowns in XLK And the drawdowns in ETFs that tend to be correlated to the S&P 500 were still relatively muted in this area here. All of that a function of a strong trend that we talked about back here. But as we've noted over the past 2 weeks, we really don't have that anymore. Up here, you can't draw those horizontal lines going backwards and hit price. Not the case today. 2 weeks ago, you could draw a horizontal line moving backwards, and this is a vulnerable trend, or at least a more vulnerable trend. This chart is dated April 14th. We covered this chart in last week's video. It's dated April 22nd. You can see the vulnerability in the trend here, similar to this period in here and this period in here. So now let's move to the week of Friday, April 29th. On Thursday, April 28th, the American Association of Individual Investors released some extremely rare and bearish sentiment readings. They have data going back to 1987 on the left side of the screen, and we are using all of the data. You can see the reading that we had this week, extremely rare. It's only occurred 2 previous times in the last 35 years. The last time sentiment was this bearish, March 5th of 2009. Prior to that, the first time we had that type of reading, September 20th of 1990. So let's put those 2 dates, here and here, on a chart of the S&P 500 index and look between point A and year end and see what did the maximum drawdown look like intra-year between that point A and year end, and how did the market finish between point A and year end. In terms of the maximum drawdown, the first case from the date of the signal here at point A to point B, on a closing basis, the S&P 500 lost 5.14%. In the second case, if you know your market history, this is very, very close to the March 9th, 2009 major low, and thus your drawdown less than 1%, 0.88% to point B. So point A is similar to the present day in some way. This tells us what our risk is hypothetically based on this signal between now and year end. What's the potential reward? In the first case, from the low at point B, it finished out the year at point C. Gain between B and C, 12.1%. In the second case, the low at point B to year end, point C up here, a gigantic gain, 64.83%. All of that seems logical and great, and it tends to align with the most accepted theory of extended and rare bearish sentiment. And since we're longer-term investors, we're also interested to know what happened from the date of the signal in each case looking out longer term. In both cases, the S&P 500 was higher 3 months later, 6 months later, 9 months later, and 1 year later. The average gain a year later, 45.63%, and we've already talked about the relatively muted drawdowns. However, you may remember on February 4th, we looked at this same data, and back then we used the 4-week moving average shown in blue here. It's the same data set, we're just smoothing it out a little bit with the 4-week moving average. You may also remember in that video, I believe the commentary said we'd really prefer to see this data here bounce relatively soon, because if it didn't bounce relatively soon, it started to look like some cases that were more concerning. And you may also remember we used this chart and the 4-week moving average in February to say if this holds, that would support the bullish case. So thus it might be helpful to know, did it hold? The answer is no. If we fast forward to April 28th, it dropped even further, so it really didn't fit the profile of we hope this holds in subsequent weeks. Thus it might be helpful to know this is the first time we've been down at this level. This was the first time here, and this was the only other time that was similar to this point here. And those dates are a little bit different. Not too different in this case. August 16th of 1990. Right side of the screen if you know your market history. This isn't a good date. This is January 17th of 2008. Just as a reminder, this data set is based on the 4-week moving average of bulls minus bears. The original look was just the data itself. There's no moving average in this case. So what happened in the S&P using the moving average signals? In both cases, the drawdown between point A and year end was relatively significant. 11.14% in this case here. In this case, horrible, 43.56%. This is in October. This is in November. In this case, the rally into year end was significant, 12.1%. In this case, the rally from B to C to year end, this is a nice looking number, but it shows you that the miracle of compounding can work against us as well as in favorable periods for us. We really don't want the miracle of compounding to work against us. You can see after you lose 43%, even after a 20% gain, you're only back to this point here relative to where you started up here. So if this is the date of the signal here, the date of the signal is in here, and it's here, how did the S&P 500 perform on a longer term basis? Probably fair to say the story is significantly different. 3 months later, basically flat. 6 months later, basically flat in terms of average outcomes. 9 months later, down about 6%, and 1 year later, down about 10%. And the maximum 1 year drawdowns, if we take the average of the two numbers we've already discussed, it's 27.35%. Since the outcomes here are in stark contrast to the outcomes here, let's take this date, and this date, and this date. So they would all be the signal dates in the two different studies, one based on the data itself, the second one based on the 4-week moving average. Let's compare the signal dates to the S&P 500 in the present day and see what we can learn. Let's start with the ugly case here. So the signal that came on January 17th, 2008, the drawdown to point B was 43%. Does the S&P 500 in the present day look anything like this point here? Meaning, should we be concerned about an additional drawdown that could be relatively significant in magnitude? And remember, this date is based on the 4-week moving average study. So if we take the S&P 500 in the present day, so here would be the signal in the present day, April 28th, 2022. And since we don't know what the future looks like in the present day, we have to look backwards to compare the two periods. So if we look backwards 1 year, this is what the S&P 500 looks like using the 50-day in blue all the way out to the simple 250-day in silver. Thus, if you're a stock market bull, you really don't want this case here, January 2007 to January of 2008, to look anything like this, because the outcomes here were very, very painful. So let's take the exact same moving averages. We're going to put point A, the signal date, January of 2008, on the right side of the screen, and we're going to use the exact same moving averages, exact same period. 1 year up to the signal date. If we compare this point right here on the present day chart 2022 to this point here in 2008, probably fair to say there are some significant similarities here. Strong trend over here, strong trend over here. In this case, in the present day, as we discussed last week, it's possible we're moving from a full bore bullish look to a full bore bearish look. Similar case here, full bore bullish here, price above all the moving averages, blue the fastest moving averages on top, and the slopes of all of the moving averages are up. That's very similar to what we had over here in 2021. This is almost the binary opposite here in the present day, April 28th, 2022, and this is almost the binary opposite over here. So it's very, very difficult to throw this case out. So we've just shown that the present day does have a lot in common with this ugly period here, signal date January 17, 2008. How about August 16th of 1990? So we're going to do the same thing again, same chart here, present day on the left side of the screen. In short, there's probably enough similarities to these two periods to say you really can't discount this period. But it's also probably fair to say that this period looks a little bit less like the present day. If we're playing match game, January of 2008 is probably a better match, and that's pretty clear relative to April 28th of 2022. And why is that relevant? Because this is telling us what the net aggregate opinion of all market participants in the present day looks like regarding all subjects on all time frames. And you can see over here in the present day, everybody's pretty bullish about the future over here. And then it morphs into something that's significantly more concerning. The net aggregate opinion of all market participants over here, pretty confident in 2007. And then over time, it morphs into something significantly more concerning. Probably one thing here that looks a little worse. This is a tighter moving average cluster here relative to the present day. This is still pretty tight, but this is worse. This would be more concerning. So we've just shown that it's probably not fair to discount or throw out either of these dates. They probably both stand. And the takeaway for us is they both have a significant drawdown before good things happen in the positive case. How about this data set? Remember, these signals were based on this chart that was all of the data. So we're not using any moving average here. September 20th of 1990 and March 5th of 2009. Let's compare those two dates to the present day. This is September 20th of 1990, and it's not really that much different relative to the chart we already looked at. So this case, there's definitely enough similarities here to say this is relevant. How about this case? This is the case if you're a bull. You'd really like this to be your case, because look at these returns and look at this drawdown and look at this. The drawdown happens, maximum 1 year drawdown, in only 4 calendar days. So in the present day, if we're significantly lower in 10 calendar days, 15 calendar days, 20 calendar days, it starts to discount this wonderful look here. So if we put March 5th, 2009 side by side with April 28th of 2022, probably fair to say they really don't look anything alike. We've been in full bore bearish mode here for several months. You have a full bore bearish look here in June of 2008. This signal comes in March of 2009. And if we're playing match game again, do we think this look here on the right side of the screen, March 2009, does this look more like the present day relative to January of 2008? I think if you study the charts, it's pretty easy if we're playing match game. January 17th of 2008 is a better match. None of this predicts the future. It just tells us March of 2009, one of our legitimate signal dates. Can't throw it out. It's a legitimate signal. Is significantly different relative to the present day. The net aggregate opinion of all market participants regarding all subjects on all time frames has been decidedly bearish for a long, long time. That's not the case in the present day. That wasn't the case on January 17th, 2008. And it wasn't the case in the 1990 cases, the two cases that we've looked at. Thus, the March 5th of 2009 signal, if we were going to stack rank them, we'd probably rank this as the least likely outcome. And this is great because we have data in the present day, extremely rare data, that's going to help us keep a flexible, unbiased, and open mind. If you want to keep an open mind about much better than expected outcomes, March 5th of 2009 fits the bill. The gain from point B, the low here, to C, almost 65%. If you want to keep an open mind about much worse than expected outcomes, probably fair to say a drawdown of 43.56% fits the bill. So how might this help us? Remember we said here, if this is the case, you would expect that the market would bottom relatively soon. In this case, it was 4 days. The drawdown was less than 1%. This is somewhat in the middle here. September 20th, 1990, your drawdown is 5% in 21 days. That's not too bad, considering really good things happen after that. These drawdowns are pretty significant here. Remember, this would be an additional drawdown, hypothetically, in the present day from April 28th of 2022. It's not from the peak. So if you get this or this, you're firmly in bear market territory for the S&P 500. So to answer how can this help us, let's put all of the drawdown data from both of the studies on a present day chart. What it tells us is the more favorable outcomes, this outcome here, and the average of those two outcomes, so the average is the dotted line, you really don't have to be too patient to see if something like that's going to happen. It basically says that this low here, for the most part, should hold, or at least the May lows back here from 2021. If those don't hold, we also learn something. It tells us that it opens the door to these two much less favorable cases. Significantly higher drawdowns on average, and the one-year performance is negative in those cases on average. So if we hold in this general area here, from a risk-reward perspective, that's worth waiting for. If we fail to hold in this general area here, it doesn't predict anything, but it tells us it opens the door or increases the probabilities that we would see something much more painful walking forward. In Q4 of 2021, so look at this volatility in this area here, and early in 2022, so let's say this volatility in here. From a long-term trend perspective and looking at the S&P 500, not really fair to say it looks like a bear market rally. The trend is just too strong. The drawdowns aren't big enough. We're in a correction at that point. When we get over here, it probably is fair to start saying that. Why? Because the trend is rolling over, and it looks like we may be going into May, possibly, probabilistically, flipping over to a long-term downtrend. And now this volatility does start to fit the profile, potentially, of bear market rallies. Thus, when we ran across a data set about rare shorter-term volatility, here's the source of that data set. Here's the Twitter handle up here where my cursor is. SPY just plunged 5% from Thursday's high to Friday's close. That's really rare. So visually, Thursday's high right here, so this is April 21st, to the close on April 22nd down here. The move from here to the close down here, 5% or greater. Now remember in last week's video, we also said that we had an outside week, we had an outside day, and the 60-minute chart at the end of the week had an outside candle as well. This also speaks to the net aggregate opinion of all market participants regarding all subjects on all time frames. And from a trend perspective, it's also noteworthy where it occurred. You can see Thursday here, April 21st, from a trend perspective, intraday, we were above the 200-day moving average. That's an indecisive look. And by the way, it's not unusual if hypothetically we are in a major topping pattern. When the trend is flipping, you're going to get whipsawed in here. It's the old Sports Center line. You can't stop the volatility when we're flipping over. You can only hope to contain it, reduce the number of whipsaws. But you can see if we do roll over, eventually we go into a clear downtrend. Not a forecast here, but it's fair to say there's enough similarities to put this on your contingency planning list. Do we think the drawdown will be this big? Wouldn't say that's a high probability, but it's not a zero probability. It never is. So we took a look at this. Since it occurred in this area and it's really rare, how many times has it happened going back to the year 2000? The answer is only 12 previous times. And this is really why we're looking at this. If you know your stock market history, these are terrible dates. These are not bullish signals. Thus, we wanted to know, what was the maximum one-year drawdown after these dates here? The answer is extremely ugly. There's really only two cases, 2011 and the 2020 case after the major low, where things were good. The average S&P 500 one-year drawdown after this happened, and it just happened recently, 15.34%. The median drawdown, 14.1%. And remember, that's an additional drawdown. That means on average, or in the median cases, when something like this happens, it means the odds are we're in a bear market because we're going to drop more than 20% from peak to trough. Again, all hypothetical, speaks to odds. So from a risk management perspective, there are two cases here where you would say, hey, we're willing to take a 2 to 3% drawdown if that's it. And then you get in some of these cases 8%, roughly 8%, 7% that are kind of tweener cases. Most of these other cases are manage risk in a big way cases. Thus, if we put these drawdowns, and we emphasize the word hypothetical, on a 2020 chart, April 28, 2022, it can help us assess the potential damage. These cases, you would be patient because that's the maximum drawdown, implying good things happen after that. But pretty much in every other case, including the average and median outcome for all the cases, for us, there would be additional risk management. We would raise additional cash in addition to the cash that's been raised between point A and point B. It's always prudent to look at the other side. Don't just look at the bad, also look at the potential positives on the other side. Even if something like this happens, so let's say we have to take serious defensive action, raise additional cash, quite a bit more, and we get a 15 to 14% additional drawdown. Should we just leave the market permanently, pack it up and go home? Say, I'm tired of this? Well, you might decide to do that. I can tell you we're not going to decide to do that because after these drawdowns, the gains on the other side were outstanding. And notice there's a lot of overlap cases here, and that's relevant because a lot of these cases occur within the context of a major bear market. So after these drawdowns, the average gain was 51%. 1 year later, the median gain was 68%. Probably fair to say that these numbers here, this signal here, these numbers here, and these numbers here, based on this signal that just came in April of 2022, and in the context of the somewhat topping pattern or potential rollover look that we have, it gets a lot easier to respect the recession probability case, that the odds for a recession are increasing, and just the look of the trend, compare the trend here relative to here. Very, very difficult to say that it's hard to comprehend significant drawdowns from here, additional drawdowns as a distinct possibility. And these signal dates, and these returns, and these drawdowns tell us it's dangerous to get stuck on any story. Dangerous to get stuck on a bearish story, and dangerous to get stuck on a bullish story. Maximum flexibility 100% of the time. Typically, the CCM market model, when we're having a correction, would allocate to defensive assets such as bonds. For example, IEF and TLT. This is stocks versus bonds, covered it many times. This is a monthly chart going back to 1990. Has a very high correlation to SPY divided by TLT. Typically, based on what we know in our careers and most of us in our lifetimes, is when the stock market is getting whacked, as it was here during the dot-com bust bear market or here during the financial crisis bear market, bonds act as a safe haven. If you look at the performance of IEF and TLT in this window here, and the performance of IEF and TLT in this window here, they did extremely well. Not the case in the present day. We really can't hide out in bonds at this point, and that's not shocking when we consider the problem is interest rates, inflation, and the Fed. Maximum flexibility includes being flexible relative to your methods. As we talk about elsewhere in this video, still have somewhat of a topping formation look here. If the present day chart moves into this area here, the longer it stays there, the more relevant it becomes. And then we get into what could be a more extended downtrend in terms of magnitude and duration. Back to the S&P 500 chart, April 29th around noon. All of the studies that we covered in this week's video, we did some back-of-the-envelope calculations to try to determine where might the probabilities, bearish probabilities, increase relative to the present-day chart. So really what we're looking for is some type of demarcation line of prudent patience where you're balancing risk management with patience, meaning nothing is binary. You're not waiting for anything. Risk management is always part of the equation. Raising cash is always part of the equation. How much you raise can be impacted by ranges and possible support. So we did this very, very quickly during Friday's session again, and I'll explain it. What it basically says is the shorter duration drawdowns in the studies that we covered this week, the bottom tended to come in roughly 7 to 13 calendar days. Now, we could be patient if we knew a low was coming in 7 to 13 calendar days, and we only had to withstand a 3.7 to 4% drawdown, and then a bottom was coming. And based on the signals that we have, here are the approximate levels where that might occur. So if we put those on a chart, you can see as of the close on Friday, we're still in this basic area. But you can really say this is the patience demarcation line, and that aligns with price. If we break out of this range, then defensive action relative to the magnitude, how quickly do you run away from risk? How quickly do you increase your existing cash position? It's going to pick up. Things will most likely be faster and in bigger chunks. But historically, the market reversed at these levels in these cases here. And these are cases that we've covered in this week's video in various studies. Why would we move away in bigger chunks here? And potentially, how much time might we have to move away? So let's say hypothetically, the S&P 500 loses an additional 10 to 20% from the close on April 29th. And that's well within the realm of possibility based on the studies that we covered this week. Not saying that's going to happen. It's within the realm of possibility. It's one of many possible outcomes, including holding in this area here. So these were the shorter duration in terms of calendar days and more shallow drawdown historical examples. In the other examples that tended to have larger percentage drawdowns and longer duration in calendar days, the median number of calendar days until the final low was hit 146, the average 160. So hypothetically, based on when these signals occurred, that says it's possible the low on the S&P 500 might not occur until September of this year. September 15th to the 21st are in that general area. And thus, if it's 146 calendar days or 160 calendar days, and if something similar occurred in the present day, we don't necessarily have to go to 100% cash in a day. In these cases, there was plenty of time to reduce risk further. And if you were to look at these cases, I don't even have to look at them. I know between day 0 and day 146 and day 0 and 160, there were some significant counter-trend rallies along the way. And it's possible that even if we fall significantly further, that we're due for a counter-trend rally. Again, not a prediction, it's one possible outcome. It's interesting to note this back-of-the-envelope calculation here tells us roughly September could be a period based on the studies that we covered where the S&P 500 bottoms. You may remember we've covered this. This is LPL research here. This is their research. Not unusual in a midterm year to get a big drawdown, over 10%. The median low came on September 4th. Very, very similar to these levels here. Once again telling us if something similar happened, you don't necessarily need to manage risk in one gigantic chunk in here. In this case, you would have time. In this case, you would have time to take further incremental steps away. And in these cases, you would have additional time. Doesn't mean that's the way it's going to play out in the present day. Just speaks to probabilities. And it's also possible that some patience in here and a measured approach could be rewarded, because if we end up having a relatively shallow drawdown that reverses in 7 to 13 calendar days, then you wouldn't want to be in 100% cash. It's that same balance. We want to balance the desire to stay in the market if it can find a low with the need to protect precious capital If the market hypothetically experienced another 15% drawdown over the next 111 calendar days, it's extremely important to keep in mind there's two sides to every coin. In every case in stock market history, there's been another side. How do we know that? We just made a new all-time high in the S&P 500 in January. This is the bad side. In these historical cases, if you could mitigate your drawdown and get to the other side with some capital intact, the reward was absolutely fantastic. The same is true here in the midterm years. Extremely painful, and it was painful all the way to the summer in these cases, or maybe even early fall. What happened after that, if you were patient and you didn't abort? Really, really good things happen. On average, the gain in the S&P 500 1 year from this low, 32.3%, the median gain 33.5%. Simply helping us keep an open mind about a wide range of outcomes while we remain prudently allocated and aligned with the charts and data in front of us. As we've discussed in recent weeks, headwinds until proven otherwise. Nothing has really changed on this front. And something can change on this front very, very quickly, which means the bull-bear odds in the market can also shift very, very quickly. Maximum flexibility, maximum nimbleness. Having said that, we don't make any assumption about when that's going to occur. Something like this, or this changing might not occur until September, and it may not occur until an additional drawdown of 10 to 20% in the S&P 500. Thus, under our approach, we're not hoping something is going to change. We're staying aligned with the data in front of us, taking it day by day. To summarize, as we've shown, rare sentiment, AAII sentiment, highly variable outcomes. Can't make any assumption about what that data means. One thing it tells us is we could still get a very, very big move up or down. I mentioned this in the past. The Fed in the present day is a different animal. The Fed is dealing with inflation. Until it's dealt with, the Fed is going to be a headwind. Some reference points have been taken out. Others remain relative to the range. And under our approach, our ongoing contingency planning takes all of this into account. I've covered these bullet points thoroughly. What do we mean by no extrapolation? Human beings like to take this chart right here and just assume that we're going to keep falling. Human beings like to take this chart and assume that the moving averages are going to continue to roll over. It's extremely dangerous. No assumptions, no forecasting, day by day. And we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.